think we're rolling. We'll give it, I can see the participant numbers going up, so maybe we give it another minute or so and then we can go for it. Cool. Okay, I reckon we're at 33 past, so should we just go for it?
Good.
Cool. Okay. So good afternoon, everyone. Welcome to the session. Just quickly by way of introduction, I'm Isla Stevenson, and I work at Cushman Wakefield. I'm also on the BCO NextGen committee in London. So yeah, I work in our occupier representation team here, and I'm joined by my colleague Kieran Patel, who is our head of offices and life sciences research. So Kieran is just going to be presenting our Central London office market update for the first quarter of the year. So guiding us through some of the key trends and insights over the first 3 months of the year, and sort of any kind of notable activity and development across the offices sector. He's also going to be presenting some of the findings from our recently released London Moves report, which is a detailed look at sort of occupier trends, the kind of the who, what, and why of the trends across London over the last year. And I know that's been kind of Kieran's life for the past few months, so he's put his heart and soul into it. So we thought we'd share some of the really interesting findings that we've had from that as well. And I know Kieran's done a number of presentations like this, so I'm sure it'll all be run completely smoothly. But as always, just let us know if there's any issues or anything. But we might not use the full hour. We've got it in for an hour, but I think Kieran will probably speak for kind of 30 to 40 minutes, and then we'll open up the floor for a bit of a Q&A at the end. So please do send through any questions that you do have, and sort of time dependent. We'll make sure that Kieran has a go at answering some of those. So I'll hand over to Kieran now to run you through the latest update.
Thanks, Isla. Not sure I can quite live up to promising that things will run perfectly smoothly, but we'll do our best. Thank you. So, hi everyone. As Isla said, I am Kieran Patel. I'm head of offices and life sciences research here at Cushman and Wakefield. And today we're going to run through a central London market update, looking at what's happened in Q1 at the start of this year, what's happened, how that kind of sits within the historic context, where we expect that to go over the year ahead and a little bit beyond, in terms of take-up, supply, rents, demand, and all of that good stuff. And then, as Isla said, finishing off with our latest insight piece, London Moves, and then with some time for Q&A at the end. So, just to start off with a bit of an agenda, starting off with an overview, just the key headlines, I suppose learning objectives, given it's a CPD session, then jumping into the leasing market, looking at take-up, supply and rents, heading into London Moves, and then opening up to Q&A at the end. So, starting with the overview, what we're going to look at. So starting off with demand, we'll be looking at take-up, which has generally remained relatively robust, particularly in the kind of traditional leasing market by historic standards, which is a strong positive sign for the market. Demand has certainly ticked up for best-in-class spaces in well-located locations, and is looking like it will persist going forward. There are some caveats to that we can add on, such as searches are becoming more stringent, more precise in what occupiers are looking for as they become more invested in their office and expect to see more of a return from their new workspace. And as a result of that, they're taking longer, and with elevated cost pressures, some are also kind of ending up re-gearing and staying put instead, all of which we'll cover. Then on the supply side, Availability is elevated overall. There's certainly no escaping that. That's largely due to a significant amount of development activity over the last couple of years and in 2025 in particular. However, beyond this year, the pipeline rapidly falls away, which, given the context of that strong demand picture, is expected to lead to grade A supply eroding quite rapidly over the medium term. As a result, we've already seen rental growth, particularly at the top end of the market, to a high degree, which is broadly kept up with, if not outpaced, inflation in most submarkets. And then as that supply picture falls away at the top end of the market, we're expecting that rental growth to continue broadly. Again, a positive sign for the market. Then just in terms of the outlook, we'll be putting all those pieces together, hopefully broadly in the context of London moves, with the concentration of demand towards best-in-class assets leading to rental growth in the core markets, which will then in turn lead to some occupiers having to compromise on their office space, being priced out of the top end of the market, if that's what they're aiming for, and having to compromise either on location or quality. In our view, and I'll explain why, we expect this to be on quality rather than location, with those occupiers generally remaining in that core market. With a caveat to that as well, that the impact of the 2026 business rates revaluation and the ripples that will send across the central London office market, as well as across wider UK commercial real estate, may mean that non-core markets also get a bit more of a look in than they've had over the past couple of years, particularly for more price sensitive, less location sensitive occupiers. So, starting off, I thought it might just be worth, not sure who we've got on the call, but I thought it might be worth just touching on central London and what we mean by central London as an office market. So here we've got an outline of that central London office market, and these the different colours represent the different markets within central London. So going from left to right or west to east, we've got the West End in that dark blue, purpley indigo colour, which includes Mayfair and St James's, kind of the core markets in some of those more central locations, as well as Hammersmith and King's Cross out to the east and west respectively. And then that leads into the blue market, which is the wider city, which includes Shoreditch up the top through to the city core, which is in that middle almost semicircular area, and then down to the South Bank as well, which is south of the river. And then that leads us on to East London, out to the east, unsurprisingly on the right-hand side there, which is Canary Wharf, outside of Canary Wharf, and Stratford up the top there in the green. So hopefully that just sets the scene a bit. If there are any questions on that, please do jump in as we go. But let's look at take-up. So looking across all of those three markets as a whole, central London take-up cut by a quarterly basis at the start of 2025 totaled 2.1 million square foot. To put that in a historical context, that's about 10% down on the quarterly 10-year average, which is typically about 2.5 million square foot, and that stretches back to 2015. However, if we kind of drill down into that data further and just look at Q1 transactional activity, which tends to be a bit of a slower quarter, just because it's mainly deals that have kind of lagged over from the previous year rather than any new ones coming to market in January or February or March, just because of the length of time it takes transactions to get over the line. If we just look at that kind of Q1 10-year average, we're actually 1% up on where we have been historically. So a positive, robust picture there. And then additionally, if we drill down into this further and look at just grade A take-up, so that portion of the market that is newly constructed or recently extensively refurbished, and generally previously unoccupied, we can see that that portion of the market has also been quite robust, broadly in line with the 10-year average and accounting for 69% of the total take-up volume. And just to contextualize that 69% a little bit, over the past 10 years, we've generally seen about 50 to 55% of take-up being of grade A quality. So you can see that real preference for better quality stock is being continued from what we saw in 2024, which recorded 65% of take-up being grade A quality, which in turn continued the trend from 2023, which was a record high of 70% of take-up being of that grade A quality. And what that speaks to is occupiers, particularly in that post-COVID period, focusing more on this better quality space in better quality locations as a means to help communicate to their employees the benefit of coming into your workspace and working hard to overcome the cost of that commute, or at least the perceived cost of the commute, ensuring that the office space can offer more as a working environment and sometimes beyond that than a day working at home could in particular. That's a theme that definitely comes out really quite strongly in the London Moves data as well, which we'll come on to towards the end. But just to ascertain, or I suppose indicate, if we expect that focus on better quality space to continue, well, if we look at the space under offer at the end of Q1, of which there's about 2.8 million square foot, which is again broadly in line with the 10-year average, 74% of that under offer space is of grade A quality. Hence, we're expecting new transactions, or transactions as they kind of filter through from under offer into actual take up over the course of the year, to continue to demonstrate that focus on better quality space. Then leading on from that, we've also seen a strong focus on pre-letting activity, so leasing transactions that have taken place before an office development has completed. In Q1 2025, that accounted for 31% of total leasing activity, which, if you look historically on an annual basis, is a very strong figure. We'd probably expect that to kind of even out over the course of the year a little bit, but remain elevated by historic standards, largely because of occupiers' focus on that better quality space and the high standard of products being brought to market across the development pipeline over 2025 and beyond. It's also probably worth noting, and we'll come on to it, that this is in part also related to the strength of the development pipeline that we've got coming through, particularly over the course of 2025. We're likely to see a record year in terms of deliveries, which I suppose helps feed that pre-letting activity. On the right-hand side, we've got a couple of examples of pre-lets that have taken place over the course of the year. Just the kind of largest ones, we've got the Cleveland Clinic in the West End, taking 110,000 square foot at 40 Grosvenor Place. The Simmons & Simmons deal, which a shameless plug, Cushman's acted for. That is a deal at Circus, and that's in fact an off-plan pre-let, which is something that has been previously very much a rarity in the central London market, with partly elevated levels of supply, meaning that occupiers don't necessarily have to turn to pre-letting space that hasn't started construction yet, so just going off the plan of the building, I suppose, which is what off-plan refers to. And I suppose there's also an element of that is related to the risk that occupiers want to take, and their confidence in offices as kind of, I suppose, the future of workspace, where they'll house their staff going forward, rather than shifting to a majority working from home model. While it's only one transaction, we have actually seen another one transact at the very start of Q2, which was that Square Point deal at 65 Gresham Street. I think they're not symbolic of a trend that we'll start to see a lot more off-plan pre-lets take place, but I think it's certainly a positive step for the market, particularly in that Square Point transaction at 65 Gresham Street, which was not only major in terms of its scale, but that building also hasn't been taken into vacant possession yet. The former tenants are still in that building, and so not only has construction not started, they haven't actually got vacant possession yet. So that's a really kind of long-term look into that particular firm, Square Point's commitment to the central London office market, and is definitely a positive sign. I think as well, just to highlight here, while we had 629,000 square foot of pre-let transaction volumes in Q1 2025, which was definitely a strong point for the market. There was a further 1.4 million square foot of pre-let space under offer at the close of the quarter, which is really quite significant. And we've already seen a few major elements of that transact since the end of Q1, including Lego, including that Square Point deal, and including State Street as well, at 100 New Bridge Street. I think finally, just to contextualize this a little bit more, so we've had 12 pre-lets at the start of Q1 2025. We've got an additional 18, which make up that 1.4 million square foot of under offer or subsequently let space after Q1. So that brings us, if all of those transact, which not all of them will, but if all of them did, that would push us up to 30 transactions for the year so far, just a little bit after Q1. And for context, in 2024, over the whole year, we saw only 30 pre-lets transact. So we're really starting to see that focus on pre-letting activity ramp up. Then moving on to take up by sector, who's actually taking up the space? Well, there's not a huge amount to say here, to be honest with you. If you look at kind of the proportions that each of these sectors, which are color coded on these pie charts over different time periods, have taken up, the banking and finance sector remains in that top spot at just over a fifth of all leasing activity by square foot, in that dark blue towards the top right-hand side of these different pie charts. Then we've got professional services, one under that in the light green. And I suppose the only point that's really changed dramatically here is in that green segment towards the left-hand side. I suppose probably about 8 o'clock if this was a clock face. And you can see that office as a service segment has risen up from 5%, 5 to 6% from 2019 to 2024. But in 2025, we've seen that jump up to 14%. That 14% is much more aligned with where we saw transactional activity for the flex office sector. That is flex office operators rather than people leasing space in flex locations. That 14% is much more aligned to where we saw that market when WeWork were really acquisitive in that pre-COVID period, probably from I suppose H1 2019 and about 4 years previous to that. However, I think it's worth caveating that 14% of take up isn't the same in terms of the construction and arrangement of the leases as we saw in that pre-COVID period. The vast majority, if not all of that 14%, is now run on management agreements and profit shares, which allow the occupier to share the risk with the landlord, as well as the landlords recognizing that having flexible workspace provision in your often flagship office building is often quite helpful in terms of getting in particularly major tenants who might want a bit of extra space to flex up and down, whether that's for growth within their company, or more likely probably a spin-out company, I suppose a special project that they want to try out, and they can just plonk that in the flex space rather than having to disrupt their standard lease space. Coming on to demand now. So this is initially a very positive picture, and I think it still is, at a record high of just over 15 million square foot of active requirements across central London, across the central London office market. However, those caveats are quite significant. First of all, searches are starting earlier. Occupiers are becoming more discerning in their search for space. They're much more focused on getting the right space for their brand and for their employees, as well as in some cases for their clients, and what that kind of says about them. While that was probably true historically, I think it's very much come to the fore now, particularly as companies try to hold a broader picture of identity within their landscape. And as a result, searches are taking longer. We've got several companies within this requirement list who are starting or are already quite well underway with their searches, that have lease events coming up in 2030 or 2032 or even 2036. I think there's one who's just launched. And so as a result of that, they'll probably remain on this demand schedule for longer. So we're kind of slightly elevating or inflating the figure. And I think there's also a note to say that not all of those will actually transact, given the increase in occupational costs. So from rents, which we'll come on to, from increasing business rates, which will also come on to, service charges and fit out costs, all broadly at record highs, particularly for core markets. The cost of moving offices has probably never been higher, and the difference on the balance sheet between what a company is paying now and what a company would be paying for their new office can be quite severe. So much so that there's been quite a few cases over the last year. Anecdotally, we don't track re-gears, unfortunately, but anecdotally we can see that that a number of deals have got to that final hurdle of getting sign off from the CFO or similar in the company, and falling short of the mark because they say that they can't sign off that significant increase in capex or opex, either or. As a result, not all of this demand will translate into actual take-up. But I think even with those caveats, it's still nonetheless a very positive picture, with a number of large requirements out and actively searching for major spaces in the market. And I say that kind of large portion of the market because that's one that's been historically, well, not historically, more recently quite subdued in the post-COVID market, with many choosing in the immediate post-COVID aftermath to kind of sit on their hands, kick the can down the road, all of those phrases, to otherwise delay their decision. We're actually seeing them come out with some more conviction now to actually get underway and transact on new office space. And that brings us on to supply. So if we start off with availability, so what's currently on the market and available, there's no getting around it. I don't think we need to, but supply is certainly elevated compared to where we were. The vacancy rate is just over 9.5% across central London, which equates to 9.8 million, sorry, 28 million square foot, which is no small number by any means. A large proportion of that is secondary space, which is proving a bit harder to shift, given that preference on grade A and better quality space. I think that's probably the more concerning portion of this graph, which is shown in the grey bars at the top there. You can see that kind of grey chunk has remained quite sticky for some time. And then in the blue bars down below, we've got grade A supply. The reason why that's ticked up is not because of a lack of demand for that space. I think the last few slides have hopefully shown that context, that there is strong demand for this better quality space. But what we have seen is a strong amount of development deliveries coming forward over the past couple of years, and particularly in the coming year, which have pushed up these grade A supply figures. Just to note on that, what we include in our kind of availability statistics, so these figures are what's on the market and currently available, and that you could in theory lease today and take it up today, and also those spaces which are under construction and due for completion within the next 6 months. So that's why it's relevant to consider what's the strength of the development pipeline over the coming over 2025 up to Q3, because those stats are already in our availability figure. If we then jump on to pre-let space, so I mentioned I think the reason why I wanted to include this slide is because it's a certainly positive step for the market. So if we look at the trend here, we can see that in the immediate kind of reaction to COVID, just at the start of 2020 there, we had a significant ramp up in sublet space, so tenants putting their office space on the market for others to let before the expiry of their lease. In many cases, that could be a floor or two of a building that they occupy. And while we had that initial really strong correction or right sizing, as it was broadly termed in the market, we then kind of had a couple of years of turbulence. But now for the last 2 and a bit years, probably coming up to 3 years now, we've had a consistent decrease in that sublet supply quarter on quarter. And given that we know that grade B take up, which this sublet space would fall into, has been really quite low by historic standards, this sublet space isn't being eroded from demand from people taking it up. It's actually being just taken back by the occupiers who put it onto the market in the first place, as they kind of, in many cases, realize that their right sizing exercise may have overcorrected, and they're now faced with a shortfall in office space for their workers, particularly as more of their staff come back either voluntarily or through the increasing amount of office workspace mandates that we're seeing coming through. I think a falling pre-let supply is certainly a good, healthy barometer for the market generally, as well as for the health of the occupiers who make up that market. I think it's definitely a positive sign and one that I wanted to highlight. And then just coming onto the development pipeline, I should say, which I suppose is our future supply. So just to talk you through this chart a little bit, on the left-hand side, I suppose before 2025, we've got these blue and grey bars. Those blue bars represent office space that was completed speculatively, so without a pre-let at the point of completion. And then the grey bars show the space that was completed with a pre-let at the point of completion. You can see that the last couple of years have tracked slightly below the historic long-term average, as we kind of bear the brunt of continued caution in the office market, particularly with the guise of major development schemes coming forward, particularly those with who are backed by US investors, where the office market has been a bit more turbulent, shall we say, in its recovery. Over that time as well, we've had significant pressures within the construction industry more broadly, from the initial kind of, well, I suppose the ongoing impact from Brexit of construction worker shortages, skilled labour shortages, and then in the pandemic period, those intensified, and then we also had the we also had the impact from supply chain pressures, including the Suez Canal, including shipping routes getting challenged by workers being scared to getting trapped on the ship if the pandemic so mandated. And then after that as well, we of course had the war in Ukraine, which is ongoing, and essentially the inflationary period, which is all tied up into those factors. And none of those have really alleviated a huge amount. So the supply chain pressures have eased off, but we've still seen really elevated levels of material prices and worker wages in the construction industry, which has put pressure on delivery. And as a result, we've seen a number of schemes slip their initial completion date, starting probably in 2022. There's always an element of this in the market, but we started to see it kind of heighten with schemes, for example, expected to be completed in Q4 2022, slip into 2023, and then from 23 into 24. And then we really hit a crunch point in 2020, at the end of 2024, when we've seen a huge amount of schemes slip into 2025. Hence, we've got that record high expected volume of construction deliveries over the course of the year. Within that, though, if we now look at the 2025 bar, we can see that deliveries are split between under construction and available, so just that red bar towards the bottom there, and then the larger portion of the two, which is under construction, but with a pre-let in place, so already accounted for by the market, already leased. And that's in that green bar, which you can see by the stats on the right-hand side, makes up, I think, 61% of the take-up for, of the development pipeline that's being delivered over the course of the year ahead. And if we remove that from the market, as well as pipeline probable, which is schemes that haven't yet started on site but are likely to, we get a kind of picture of what's under construction and available this year, which falls below the volume last year and falls below average. And then it only decreases from then on, particularly from it falls away slightly in 2026, but then in 27 and 28, we really start to see this development drought start to kick in, with no schemes under construction currently expected to deliver in 2029 across central London. To put that in context, we had, I think, across from 2026 through to 2028, so just those red bars, those 3 red bars on the far right-hand side there, that amounts to just under 6 million square foot of under construction and available supply. And across central London, on an average basis, we have about 6 million square foot of grade A take-up per year. So across the next 3 years, we're expecting just 1 year's supply to be delivered to the market. Hence, we're expecting that grade A availability to be eroded quite rapidly over the year ahead, over the medium term, sorry, slightly longer than the year ahead, I would say. And that brings us on to rental values. So given that we've seen those that focus on grade A and better quality space, there's a component that buildings are just getting better. And because of that, we need to start to, it doesn't come free, right? If you're getting a better building, you have to pay a bit more to get all those new bells and whistles, without going into the detail of exactly what those bells and whistles are, but accreditations, amenity offer, and the like, that we're seeing this next generation of buildings really start to deliver. Coupled with that, we do have supply shortages as well, in particularly core markets, and those factors combined with broader inflation pressures across the market have led to record high rents being achieved in all central London submarkets, with the exclusion of Hammersmith, which has seen a bit of a challenge in terms of demand amid a broadening out of supply as well. I won't jump into any market in detail here, but we will go on to look at our prime and super prime rental growth forecasts for the city core on the left-hand side and for the core West End, so Mayfair and St James's on the right-hand side. And what these charts in the table below shows are the kind of historic rental growth that we've seen in the prime rent, which is shown in the grey lines, slightly below the blue lines, which showed the super prime rent. And if we look, starting with the city on the left-hand side here, we can see that while we were at 86.50 at the end of 2024, we're expecting a tick up to just shy of £90 at the end of 2025 in the prime rent, I should say, in that grey line. And then by 2028, we're expecting that prime rent for the city core market to be at £100 per square foot. That, to put that in context, if you're slightly less familiar with the market, I'd say back in 2020, we'd probably have maybe 1 or 2 deals per year that would very much make headlines as being the top rents achieved in the city core submarket at the time. So it's by historic standards an extremely high rent that was previously a rarity, but is becoming increasingly common, so much so that by 2028 we're expecting that to be the benchmark rent for grade A good quality stock. That isn't, however, the best stock. That super prime stock shown by the blue line, we're expecting rents to continue to increase at a faster rate than we've seen at the prime end of the market, continuing to bridge that gap between your good quality grade A stock and then the best stock, your super prime. And to put that in context, while we're expecting £100 per square foot at the prime end of the market, we're expecting the super prime to rise to about £160 per square foot by that 2028 period as well. So really quite strong growth there. As buildings get better and you have to pay more, and then as that development drought starts to kick in and the supply of those better quality assets really kind of shrinks away amid strong demand. Then if we look over to the right-hand side on the West End, a very similar story here, but the rents are in a slightly different league. We've got the prime rent in the grey there expected to hit £200 per square foot by 2029. We're at about £160 now. We're expecting that to move out to 170 by the end of the year, if not next quarter, and then just continue to grow as the supply shortage in the West End becomes more and more acute, which has historically been the case, but is growing in severity now, and isn't just limited to those super prime assets in the West End, although that is very severe. We're also quite short of grade A supply in Mayfair and St James's in particular, so much so that we've actually seen occupiers having to move out into adjacent submarkets such as Soho, such as Fitzrovia or the north of Oxford Street, as the supply crunch in that core West End means that they can't find the space that they need in those markets. And in fairness, the kind of gentrification, the delivery of new best-in-class stock in those adjacent submarkets comes out, meaning that they have somewhere to go as well. So that's I suppose the traditional Q1 market update covered. But now if we jump into London Moves. So for those of you less familiar with the report, it's available online. Please do go and check it out. It's the study of who's moved where and why across the central London office market. So what we do for any given year is we look at all the leasing transactions that have occurred over 5,000 square foot, and look at the occupiers and work out where they've moved from, the size of their former lease, the rents they were paying in their former location, and then we look at where they've moved to. Again, looking at size, rents, length of lease, everything that we can find, and then we dig into it on a market basis, with the ability to drill down on a granular submarket or even transaction by transaction level. I think the differentiating thing about this report as well is that we've got about 12 years of data behind this. So for any of those trends that we do identify for any given year, we can then put it in a historic context and work out whether that's just a one-off that's unlikely to progress further, or if that's kind of a trend that we've seen developing over time and is therefore likely to continue to evolve. So across the report this year, we had 3 key themes which came out of the data: focus on the core, loyalty to local, and more and better. And we'll dig into each of those in turn, starting with focus on the core. So to set the scene for this particular trend, we're going to start off by looking at 20,000 square foot plus leasing activity across central London in the pre-pandemic period from 2015 to 2019. And what you can see on the map here is that we've got kind of a broad blue splash of activity across the central London submarkets, with these red clusters of more intense areas of activity also well distributed across the submarkets, showing that tenants were relatively footloose by current standards as to where they'd move to, where they'd lease space, and where they'd be willing to house their employees, and I suppose also where their employees would be willing to go by extension. Then we've got in the core markets, so around the city core, you can see that kind of white hot cluster of more intense activity, which shows the most intense activity across central London, as well as in Victoria and in the core West End there as well. But we're going to see how that's changed now in the post-pandemic period. So if we grey that out and leave it as a point of reference, we can then look at the post-pandemic period. So again, transactions over 20,000 square foot across central London, but this time from 2022 through to 2024. And what you can see here is that activity has really shrunk away from those fringe, more peripheral locations, particularly out in the west, particularly out in the east, north, and south, to instead focus on the central core markets, with those white hot clusters, particularly in the city core as well as in the West End core, and to a lesser degree in Victoria as well, remaining more robust and in fact growing in demand. Why is this happening? Well, speaking to a point that we raised earlier, occupiers are increasingly focused on those better quality assets, which have in large part been delivered in these central locations. These central locations are also able to offer the highest amount of connectivity, and enabling staff to better kind of reduce the commute of their current and future workforce, as well as being generally the highest amenity locations as well, meaning that when staff do come into the office, they can access the full thrills and spills of central London and help employers in turn communicate the cost, or help employers communicate how employees can overcome the cost of the commute, as the phrase goes. What does this mean? Well, for non-core locations, so if you're in a location that is now more grey than blue across the map, you're going to have to work that much harder in order to entice occupiers to make that move slightly further out, or to stay in that slightly further out position, and work with them to help them in turn communicate how your slightly more off-piece location can work for their employees. Then coming on to loyalty to local. So here again, setting the historic scene from 2014 to 2023. So for the previous 10 years, we saw occupiers move on average just 1 mile from their former to their new office. And that's a figure that's remained stubbornly stable around that 1 mile mark, ticking up or ticking down by 0.1 of a mile year on year, but not really moving a great degree until 2024. When we've seen a record low distance moved of just 0.7 miles from an occupier's former to their new office. And we can break that down further, with 185 occupiers moving just under half a mile. Included in that would be Legal & General, who moved around about 100 meters down the road from their former office to the Woolgate Exchange, exemplifying the focus on the core trend. That's a city core transaction, very much around, within walking distance for sure from Liverpool Street Station, accessing that Elizabeth line connectivity, but also one that remains very loyal to their location, as Legal & General in this case, but occupiers more broadly are much more sensitive to not rocking the boat in terms of their employees' commute. Adding 5 or 10 minutes onto someone's commute who's chosen maybe to live in a certain location because they know that they can get into work in 40 minutes. If it now takes them 50 or longer minutes to get into work from their home, they might be they might have a few grumbles about that, and then that can be the difference between them choosing between company A and company B, or whether to stay here or move to that other company. While that's always been a factor, I think it's really that work-life balance has become even more at the fore in the post-pandemic period, and is one that employers are particularly keen to get the messaging and do right on as far as possible. Then we had 61 transactions moving between half a mile and a mile, and then just 60 transactions which moved over a mile, which is a record low number of those slightly longer distance moves. Interestingly as well, we can cut this data by rents, and if we look at occupiers who paid higher rents, we typically see them moving lower distances. That is to say, there's an inverse correlation between the two. For those paying over £100 per square foot in rent, so that probably the top end of occupiers in terms of rents paid, we saw an average distance moves of just half a mile. Not very far at all. To put it in context, that's the distance roughly from Tower Bridge to London Bridge. So, a little over a 5-minute walk, maybe, not far at all. Then our third and final theme for the day is more and better. Now, this sits in contrast to the less but better headlines that have kind of been circulating around, with the theory being that companies are opting to take slightly less space but of better quality and paying higher rents for it. So their kind of overall liabilities generally remain on about level. But what we've actually seen in our data is that while that might have been the case for some occupiers across the market, the majority of occupiers, 78% in fact, expanded on their former office footprint into their new office. On an average basis, that amounted to an increase of about 35% in square foot terms from your former to your new office, so quite a substantial expansion. And across the market as a whole, that amounted to 3.3 million square foot of expansion in terms of their occupied office space on net. Interestingly as well, that expansion was seen across all size bands. So you can see on the chart on the right-hand side here that all of those blue bars at the top, which show expansion, outweigh those grey bars at the bottom, which show contraction. And those little yellow dots there all remain positive, showing we were expansionary across all of these size bands. And particularly of note, we were expansionary on that 100,000 square foot plus transit portion of the market, which for the past 2 years has in fact been contractionary, with those larger occupiers tending to contract in their space rather than expand. However, in the last year, we've actually seen that flip on its head, which is certainly a positive for the market. And then on the better side of things, we've already referenced this, but 65% of take-up across 2024 was of grade A quality, very much continuing the trend that we saw in 2023 and looking like it's continuing in 25 as well. Hence, occupiers are taking not only more space, but of better quality as well. So those are our 3 key themes across London moves. But I think there's a common thread that links them all, and that is employee-driven decision-making in real estate strategies being enacted by occupiers across scales, whether that's focusing on core markets with high connectivity and high amenity, whether that's not rocking the boat in terms of the commute, or whether that's delivering more space for your employees so everyone has a desk and of better quality as well, so that your employees can be at their most productive for any one given task, whether that's collaborating with employees, whether that's entertaining clients, or whether that's quiet focused work. Modern offices need to have spaces, tech-enabled spaces, we should say, that can deliver for each of those in order to outcompete at home and overcome the cost of that commute and ensure that employees aren't limited in what they can do in the office. While those are the trends that we've seen over 2024, a key question to ask is, will they continue over 25 and beyond? Well, in looking at this, we can look at a few key factors. We're just going to look at 3 quickly. I'm going to try and speed up a bit because of time. First of all, supply. We've got that tightening best-in-class supply, which is one that we've very much already referenced. And as a result of that, we're expecting core take-up rather than demand. Core take-up is going to be filtered by rents. Those higher margin companies that can afford to outcompete their competitors or the next potential occupier are going to do so, hence pushing up rents at that top end and outcompeting other potential occupiers. As a result, that's going to draw rental growth, particularly in core markets, and mean that some of those occupiers who were targeting those super prime spaces, as we just said, are outcompeted, and so are left with a decision on whether to compromise on their location. Should they remain in a core market or go to a non-core market, or should they compromise on quality? Should they go from targeting a super prime building or a grade A building or a grade B building, move down that quality spectrum as things get more affordable? And if we look back to our 3 key themes, we had 2 which were location focused, which are loyalty to local and focus on the core, and just 1 that was quality focused, more and better. And hence, I think for the majority of occupiers, we're going to see that compromise fall on the favor of location, i.e. occupiers are going to stay in that core market and compromise on quality instead. If you're aiming for super prime, you might end up in a grade A. If you're aiming for grade A, you might end up in a grade B. As a result, that's going to pull up rents across that quality spectrum as demand also gets pulled up across this quality spectrum. And then finally, business rates. So the 2026 business rates revaluation is looming, and it's the impacts, while still awaiting final confirmation from government, promise to be quite substantial, materializing in about a 38 to 49% increase on a per square foot basis in rates liabilities on versus the current rates liabilities for 2024 across central London occupiers. This is really quite a substantial figure, and it's going to be most prominent in those core markets where we've seen the strongest amount of rental growth over the past 3 years, from 21 through to 2024, which is when the rates period is calculated. As a result, non-core locations that haven't seen as strong rental growth over that period are likely to improve their relative value proposition versus those core markets. And given that all those other factors as well are likely to push up occupational costs with high and growing rents, high and growing rates, increasing service charge and record high fit out costs, as we mentioned at the start, all of those factors are increasing occupational costs. Hence, we might see an increasing number of companies get slightly more price sensitive. And so the appeal of those non-core markets are likely to tick up going forward. It also may mean that we see an increase focused on fit out costs, an increase focused on fitted space and fitted solutions, whether that's flex space or Cat B space, or working with landlords to help spread the cost of fitting out a space over the term of a lease, which means that we can change a upfront capital expenditure cost, which is often very significant, into an OPEX cost, which is a lot easier to spread over the balance books. And sorry, I've talked for far too long, but that is the demand, supply, and outlook for the Q1 market update across central London, including London moves. I hope that was all fairly interesting. And any questions, be happy to answer as best I can.
Thank you, Kieran. Yeah, I mean, I live this day in, day out with my job as an occupier representation, but I still find it really interesting, particularly all the London moves data that you've collected. So hopefully that was really insightful for everyone on the call as well. We've had a couple of questions come through, and just given time, I'll go through the order that they came through, just so it's fair. But I think Kieran, probably it's fair for me to say that you're more than happy to kind of pick up anything with
Yeah, of course.
anyone else. Particularly, we've had a question on the investment market as well. So anything in that sort of vein, I'm sure Kieran would be happy to pick that up with anyone separately and share some more insight on that. So first of all, we've got a question just on what are the other kind of bells and whistles that are driving rent costs up the most, sort of beyond location. I know you sort of touched on this, but yeah, it'd be great to hear from you what you're seeing as the most sort of prominent feature of these high rental buildings.
Yeah, so location is definitely up there, as you've highlighted. Beyond that, sustainability is always probably number 1 and 2 on that list in terms of EPC A and B. BREEAM, excellent, outstanding. More frequently now, neighbours as well. And then for the buildings of scale that can afford to offer more within their footprint, such as 40 Leadenhall, the sky's almost the limit. We've got communal terraces, dedicated terraces, cinemas, gyms, wellness studios. They've got a library as well, a number of other things I'm forgetting, including a sauna.
Auditorium, restaurants. I think they've got 3 saunas
Yeah,
in there.
yeah. And a nail bar, I
Wild.
think.
And a nail bar, hair
Yeah.
salon.
So everything. I think maybe there'll be some rationalization in terms of what buildings look to offer, and particularly those of who don't have that scale to their advantage. They can't kind of roll up the cost of offering 10 different amenities into a service charge. And also in many locations, you simply don't need to do that, because in central London, you might have 3 gyms that are within a 30-second walk. Same for the restaurant point. But I think anything that can differentiate your offer is generally valued by occupiers.
I think also there's the point around so the viability of schemes as well, and the cost of construction, which is also obviously driving those rents up, because in order for it to be viable to build, there's sort of certain rental levels that need to be met as well, which contributes to that spike. Another question we've had is, what backlash, if any, do you expect from these rise of rental rates? And I suppose that sort of links to, like, will occupiers continue to kind of to pay these high levels, or is there a point where they just simply won't be able to anymore?
Yeah, I think it's a really good question, and probably one of the front of everyone's minds, particularly developers, as you say, with that development viability pressure. I think it is probably occupier specific and sector specific as well. We've seen that those companies that have done very well over the past couple of years, particularly private equity, hedge fund investors, that kind of market have done well off the positive movements in the stock market. They've been really acquisitive in their space and in many cases have pushed rents on. For them, probably the proportion that rents make up of their wage bill and of their overall profit is really minimal, whether they're paying £80 or £100 or up to £200 maybe. It remains quite low down on their balance books priority list probably. So they may well have room to grow still. I think where the conversation gets a bit trickier is probably for global occupiers who their global boards will see their occupational costs not as the great benefits in productivity and amenity and staff retention and attraction that they can offer, but instead they'll see it as a number on a page next to the numbers of other global cities. So how do your occupational costs in London compare to New York, compared to Tokyo, etc., etc. And if London sits outside of the norm, if it sits too far above, then it simply won't get the sign off. It will be go back to the drawing board, find something cheaper, find a new location, do something, but we're not going to sign it off. So I think there could be a limit on that, and that could again favour the non-core locations. But I think there won't be a shortage of high paying rents over the near term at least.
Yeah, I think it will also be interesting with, as you mentioned, the business rates sort of revaluation and the extent to which they're predicted to go up, and the impact that will have on occupiers, and adding an extra £20 per square foot, £30 per square foot when you're negotiating on a pound on the rent, but actually your business rates are going up that much. I think that'd be really interesting to kind of monitor as well over the next few months. So we're at 1:30 now. There's probably one more question that we'll go for. Is there an oversupply situation over the long-term horizon, so over the next 10 years in the city?
You might have had more of an argument to say that there would be coming up in the pre-COVID period. And probably in 2020, that was very much the discussion of, we've got all this office space, we need to convert it tomorrow into care homes, into residential units, into shops, into whatever else. But I think now, looking at where demand is and looking at that development pipeline graph in particular, given those viability pressures that we have and ongoing investor hesitancy about pressing go on new schemes in the market, I think we're likely to see grade A supply really erode quite consistently, if not strongly, over the medium term, over the next 5 years at least, at which point the development cycle will probably kick back in, and we'll start to see a bit more development activity as values have recovered and investors get a bit more confident, and those rents kind of help push the viability question. Probably a slightly different story on secondary stock or in non-core locations, where we have seen and continue to see an increasing amount of repurposing. I think again, given the development pipeline, however, and increasing focus on carbon budgets and embodied carbon in particular, refurbishment is likely to become more of the norm rather than new schemes coming forward, kind of built up from the ground, demolition and build up. And as a result, I think we will see that secondary stock be eroded from repurposing, but also from repositioning as well, and being converted into grade A or even best in class in some cases. So I think both of those markets suggest that I don't see a huge risk of oversupply. But maybe I'm too close to the agents on this. Maybe they're thinking my view.
Fab. Okay, well, yeah, conscious of time, there's another couple of questions here. So I've taken a note of them, and the names of those who submitted them. So perhaps we'll be able to get back to you separately on those two. But yeah, for now, thank you so much, Kieran. Really insightful, and hopefully
Lovely.
everyone's got a good hour of CPD out of that one. So thank you, and tune in for the next one.
Thanks all.
Great.
Thanks for tuning in.
Thanks,
Thanks,
everyone.
Alan.
Bye.
Cheers. Bye. Bye.